Gold prices in new record territory today. December futures topping $4,000 an ounce. Investors apparently looking for havens with the US dollar under pressure. Let's get more from Daniel Ghali, Director of Commodities Strategy at TD Securities. Daniel, thanks very much for joining us.
Absolutely. Thanks for having me.
What's causing this latest jump in gold, do you think?
Well, Andy, what's funny is that for the first time this year, we see signs of extreme FOMO in gold markets. Right. The incredible rally that we've seen so far in gold is ultimately a function of the fact that the U.S. dollar is at least partly losing its store of value function. We've been arguing this for months now. But what's interesting is that the last piece of this rally has really been quite different than what we've seen over the last several years, over the course of this bull market. It's different because China is notably absent from the ongoing rally because for the first time in many months, macro funds are no longer underpositioned in gold. Algorithmic funds are holding their largest position size. Retail participation is at a decade high. We see signs of extreme FOMO here in gold markets.
Yeah, extreme FOMO, that's interesting. So, this long-awaited phenomenon the gold bulls have talked about, the generalist funds are piling into gold?
We certainly see some evidence of that. Generalist funds are piling in, but also one notably absent cohort has been the discretionary trader community. Those are the contingent that would trade gold on the basis of a Fed cut view or on the macroeconomic basis and so on and so forth. They've actually missed a large chunk of the rally thus far this year, notably because in the immediate aftermath of Liberation Day, gold prices rallied $500 an ounce at a moment in time where most of the market was concerned about a margin call event or a deleveraging event, if you will. Since then, they were sitting on the sidelines, and we think after the summer lull, they came back in force.
That's interesting. And the U.S. dollar, who knows, but it's certainly tarnished right now, you think, as a safe haven asset or as a predictable asset?
Well, I certainly think that's the market narrative out there. How else can you explain this idea that we're seeing equity markets rising at the same time as we're apparently in the beginning of a new bond bull market, at the same time as credit markets are at their tights, at the same time as commodity prices are rising and gold prices are ripping? The common thread in all these assets is their denominator, which is the U.S. dollar, the world's reserve currency. The only way that the market can be trading in this fashion is if the denominator for all assets prices is actually declining in value. The rub here is that there's no guarantees for this mega theme. As we enter into the end of this year, we think we're nearing an inflection point where the Supreme Court decisions will have a meaningful role to play in whether or not this trend can persist or whether or not it will have to reverse.
What Supreme Court decisions do you mean, Daniel?
Well, there are certainly several that are on the docket, but most notably, in our view, are the decision on whether or not President Trump can exit Fed Cook and the decision on whether or not the IEEPA tariffs are ruled legal or illegal.
Daniel, we'd better leave it there. We've only about 20 seconds. Do you see, is your inclination that gold goes higher from here? I know it's a very hard prediction to make.
Well, it's certainly very hard, but we actually think it's time for a pause in the bull market in gold.
Thank you very much, Daniel. I really appreciate it. Daniel Ghali, Director of Commodities Strategy at TD Securities.